BlackRock, a name that dominates the financial world, wielding unparalleled power and influence across global markets. With assets valued at nearly $10 trillion, BlackRock is more than just a company. It's an empire that shapes governments, controls industries, and molds the very fabric of our economies. Today, we're pulling back the curtain to expose the dark side of BlackRock, the secrets, the power plays, and the unsettling truth about who really controls the world's largest asset manager. Opening scene. BlackRock, the largest investor on Earth, owns over $9 trillion in assets, equivalent to about 1/10 of a year's global economic activity. This wealth gives money managers significant influence in the world's operations. BlackRock owns at least 5% of most major companies, giving them significant voting power over public business operations. BlackRock rose to the top of the financial system quickly after its IPO in 1999, with its stock increasing 7,539% through December 2020. The company used technology to minimize investment risks and provided diversification in investment portfolios at a relatively low price. BlackRock's risk management strategy has allowed it to adapt to changing climates and push global institutions into action. BlackRock's relationship with the Federal Reserve is beneficial for the public, as it helps the central bank make a difference in improving lives and potentially making some people rich. BlackRock's success in the financial industry is a testament to its ability to adapt and grow in the face of changing circumstances. The evolution of BlackRock. BlackRock, a major financial firm, was founded in the late 1980s by Larry Fink and his team under the management of Steve Schwarzman. The company developed a risk management software called Aladdin, which uses a Monte Carlo-styled algorithm to identify potential investment failure scenarios. Over the past 20 years, financial markets have become more complex, with volumes increasing exponentially. The explosion in computing power and the rise of cryptocurrencies and robo-advisors have led to the convergence of these technologies. BlackRock's tech-driven approach has made it a major firm, with managed assets swelling over time. In 2006, the company acquired distressed assets of Merrill Lynch and took over Barclays Global Investors in 2009. Today, BlackRock owns the intellectual property rights of iShares, which is one of the most heavily traded names in the stock market. ETFs, or exchange-traded funds, have become central to BlackRock's empire, allowing investors to diversify their portfolios and have been shown to be a key factor in successful investment programs. A look at BlackRock's strategy. Exchange-traded funds, ETFs, can be envisioned as thematic collections of stocks, akin to baskets that group together various investments based on specific criteria. For instance, BlackRock provides funds that are linked to both large corporations and smaller municipalities, as well as those that track sectors like oil and gas exploration and the defense industry. These ETFs offer investors a diverse array of holdings at a remarkably low cost. To illustrate just how affordable these costs can be, consider BlackRock's S&P 500 ETF, which charges investors a mere 30 cents annually for every $1,000 invested. The competitive landscape among fund providers has driven fees down, benefiting investors significantly. The ETF market is predominantly controlled by three major players, with BlackRock leading the pack, holding approximately 35% of the domestic market share. Vanguard and State Street follow, each capturing between 15% and 20% of the market. This concentration has transformed financial markets in a relatively short period, with over 80% of all assets invested in the last decade funneled into one of these three giants. According to legal scholars from the National Bureau of Economic Research, the financial and technology sectors are particularly prone to such concentration, especially in the case of competing S&P 500 index funds, which tend to hold nearly identical portfolios and yield similar returns before expenses. Therefore, from an investor's standpoint, the most prudent choice is to select the fund that incurs the least cost, which is typically the largest one due to economies of scale. BlackRock's ascent in popularity has paralleled the surge in interest in passive investing strategies. Beyond managing individual wealth, BlackRock oversees sovereign wealth funds and has developed a growing private equity division. The firm also extends its lending services to emerging markets in Asia and beyond. A significant portion of BlackRock's revenue, 78%, is generated from investment advisory fees associated with products like ETFs. This substantial financial footprint is likely why BlackRock frequently appears in news articles and why its leadership is often featured in media discussions. BlackRock is positioning itself as a socially conscious voice in the financial industry, focusing on environmental, social, and governance (ESG) standards. This approach addresses specific issues related to climate change, boardroom diversity, and the composition of the board of directors. BlackRock's plan is to issue funds with stricter ESG standards on business conduct, which is a form of active management. However, it is not clear that these funds can outperform the performance of a broad market index. BlackRock's leadership believes that these societal issues will impact the bottom line over the long term. BlackRock owns a 6.7% stake in ExxonMobil, responsible for nearly 2% of global emissions. In 2020, BlackRock raised climate concerns with Exxon and joined a group of activists and peers to push 3 board members out in 2021. This represents changes in capitalism, where the importance of ESG is not just about profitability, but also about moving businesses in a different direction. Exxon now plans to end routine flaring of natural gas by 2030 and disclose more climate-related risks. Tighter standards on public corporations may help, but they could also push polluting activity and risky assets into more loosely monitored private ownership. BlackRock, investing in the entire S&P 500, is only investing in a small part of fossil fuel production, as the largest oil and gas producers and carbon emitters are state-controlled enterprises that are not subject to pressure from U.S. money managers. Navigating the green transition landscape. BlackRock has recognized the potential for the green transition to lead to increased prices and heightened political tensions on a global scale. Major corporations and financial institutions are now being viewed as gatekeepers, tasked with the responsibility of limiting their business dealings or lending practices to companies, particularly smaller firms, that have yet to reduce their emissions. This approach may inadvertently incite a backlash against larger corporations, fostering a narrative that pits big businesses against smaller ones and exacerbating political polarization. BlackRock's advocacy for improved societal stewardship initially gained traction within the European Union, where the investment firm contributed to the development of a framework for sustainable investment. Meanwhile, U.S. regulators are also prioritizing climate risk, viewing it as a critical component of their existing oversight responsibilities related to bank supervision and financial stability. BlackRock is implementing a comprehensive strategy to mitigate climate-related financial risks, focusing on thorough analysis, public engagement, and transparency. The Federal Reserve has historically sought BlackRock's expertise in managing funds during economic crises, with a close relationship between then New York Federal Reserve President Timothy Geithner and CEO Larry Fink. During the 2008 financial crisis, Geithner enlisted BlackRock to oversee Bear Stearns and AIG's distressed assets. As the COVID-19 pandemic unfolded, the Federal Reserve turned to BlackRock, acquiring trillions of dollars in various assets, including corporate bonds, as part of its response to the economic fallout. BlackRock has been appointed to manage a portion of the purchases, but experts warn that the Federal Reserve could raise conflicts of interest. The company's 2020 annual report warns that their importance could lead to more oversight from the Fed. The Federal Trade Commission is reviewing standards on acquisitions and mergers, which could impact mutual funds' bottom lines. The Securities and Exchange Commission is reviewing derivatives markets, which could impact BlackRock. BlackRock is now exploring new sources of yield, such as real estate investments and artificial intelligence. They are also exploring cryptocurrency, but the company's leadership believes it is a footnote. BlackRock is focused on the long term, overseeing trillions of dollars in assets, and their technology can help scale low costs. However, there is no guarantee that their ESG plans will succeed the SEC's mission of protecting investors. As we look to the future, the question remains: is BlackRock's dominance a force for good or a threat to our economic freedom? Thank you for watching. Don't forget to subscribe for more deep dives into the forces shaping our world. Leave a comment below with your thoughts on BlackRock's role in the global economy. Until next time, stay informed, stay vigilant.